In today's video, we're going to talk a little bit about the portfolio, which went up 3.19% compared to the S&P 500, 1.74% in the last week. Since we started the portfolio, we are up over 72%, whereas the S&P 500 is up 22.39%. Now, the title of this video, I don't know what that's going to be, something about buy stocks, don't look at the market or something like that. I don't know, maybe Tom Lee will feature in the thumbnail. I don't know, but I do want to touch on a couple of things that Tom Lee mentioned in his own presentation late in 2024, and then touch on what Stanley Druckenmiller did say as well. And maybe let's start with that.
The economy is very interesting. We're at a very low unemployment rate, 4% essentially. We've got 3% GDP growth. And I've been doing this for 49 years, and we're probably going from the most anti-business administration to the opposite. So we do a lot of talking to CEOs and companies on the ground, and I'd say CEOs are somewhere between relieved and giddy. So we're a believer in animal spirits. Paul Ryan was on your show last week talking about a 32% increase in business confidence over the last 12 months. I think that's probably a record in terms of change. So the economy looks very, very strong, at least for the next 6 months, which is about as far out as one can see with any degree of confidence.
And the next 6 months thing here is very interesting because we've been hearing Tom Lee say the exact same thing, right? He thinks that in the first half of 2025, the markets will continue to rally, but then in the second half of 2025, we might see some weakness. We're going to touch on that later. So let's continue with Stan here. Stan, my guy, my friend.
In terms of the markets, I would say it's complicated. Despite what I just said about all the wonderful things about the economy, we have an earnings yield to bond yield, probably the most unattractive level, not probably the most unattractive level in 20 years. So you're going to have this push of a strong economy versus bond yields rising in response to that strong economy. And that kind of makes me not have a strong opinion one way or the other on the market. I will say this, in my business, every change creates change in security prices, and having this kind of radical change from one administration to the other, in addition to what's going on in the private sector with innovation, then you got deregulation from the government, disruption. I think there's going to be plenty of change and plenty for your viewers to do. I wouldn't worry about the market. I'd focus on individual stocks.
And that's something I've been saying for a while now. I've seen a lot of comments, right? And I've said it as well in those cheap stocks to buy, stocks at 52-week lows and stuff like that. Yes, markets can be at all-time highs or near all-time highs, can be expensive. That doesn't mean that a lot of stocks are not at attractive prices. Both can be true. Now, it's also true that when the overall market goes down, usually it doesn't play favorites, right? Even the cheap stocks will go down as well. But you as an investor, if you bought a stock that you think is cheap, good business, and the overall market goes down and it takes that stock down as well, what did you get? Well, you just got your stock at a cheaper price, yet the company did not change much. Perfect combo, right? It's the same with the earnings season, right? We're now entering, well, I would say close to peak earnings season. All the big companies are going to report earnings in the next couple of days and weeks. So it's going to be quite an interesting time on this channel. But what is the best case scenario? The best case scenario is basically, well, a beat across the board, good commentary on the company and all of that, yet the stock goes down. That's the best case scenario. So yeah, all in all, if you keep asking the same question, market's expensive, it's too high, still time. Yes, if you buy individual stocks, I still think that you can find quite a lot of quality. Now, with regards to Tom Lee specifically, back in December, he talked a little bit about their projections for 2025. So the base case is equity risk on first half, S&P 500 to 7,000, fundamental visibility weakens, and then year end at 6,600. The thesis here, two puts support stocks near term, Fed put as inflation eases and Fed focuses on supporting employment, Trump put as White House implements policies to boost confidence and earnings per share, reallocation of investor capital from bonds, cash to equities. Then the tale of two halves, so after back-to-back 20% gains, that only happened 5 times before since 1871. Cumulative 4-year increase of 69% versus 21 to 2024, tracking right now, well, back then, 27% with 1 year left to, well, be in the exact time frame. So you can see there's still quite a lot of upside possibility left. 4 of the 5 precedents saw stocks fall in the 3rd year. Only positive was 1996. 5 of 5 precedents saw stocks do worse in the second half of year 3. So this is why he basically said first half, good half, second half, not that good. Now, what could go wrong? What could go wrong is this. DOGE, the Department of Government Efficiency, is too effective and GDP falls on spending cuts. And the second one is tariffs are actually implemented and GDP is impacted. Okay, let's see how realistic these things are. Then he goes on to talk about EPS and PE, the expansion of those multiples, etc., etc. His best ideas are top sector picks, small caps, financials, industrial, and then Bitcoin. So there is that. Then he goes on to talk a little bit about the, well, DOGE, the Department of Government Efficiency. So it's going to be negative for healthcare, coupled with RFK heading HHS. I don't think he has been elected just yet. Correct me if I'm wrong. And the second negative is government contractors, so defense, IT consulting, etc., etc. He does say one positive thing here, that's going to be for the productivity providers, such as Palantir. I'll do a specific Palantir video, not a shareholder anymore, going to earnings, so I'll do a specific video, thoughts going into earnings and why I still think 2025 is going to be a very good year for Palantir and when I will jump back in. And then the last one here, positive bond market via lower yield. He also said that he hopes that the Fed doesn't cut that much this year. Why is that? You might say, that's quite a strange thing to say, right? But no, if they don't cut, it actually makes a lot of sense. If they don't cut a lot in 2025, that would mean that the rate cut cycle just gets longer and longer. And that's going to be positive for the long-term bull market, because that means you're going to get some rate cuts this year, you're going to get some rate cuts the next year, and then maybe even some rate cuts the year after that, if you really only do 1 or 2 cuts a year. Which again, every year that you have rate cuts, it usually helps. So all in all, going into this earnings season, it's going to be quite a, I would say, a volatile one. I think the market being the market, right, at all-time highs, it's going to be important to focus on specific companies. But we also know that some companies in certain sectors will move the other companies in that specific sector, whether it's the cloud providers, whether it's in advertising, social media, chips, etc., etc. Those will affect one another. Some companies have super high expectations while the others not that high. So it's going to be quite easy to beat those things. And then since we are at the start of the year, a lot of focus will be on that 2025 guidance. It's a pretty big week this week with the likes of Tesla, Meta, Lam Research, ASML, Intel, Apple. I believe Apple is also Thursday. And well, of course, SoFi on Monday, which we're definitely going to cover as well. All reporting. So it's going to be quite a hectic week, but a very interesting one. Now, the portfolio is still performing quite well. I would say year to date, we're already up 7.78%. I actually didn't do anything in the last couple of days. Didn't buy, didn't sell, didn't do anything. So nothing much has changed. SoFi is still number 1 in the portfolio. Then we have PayPal, Google Alphabet, cash 8.45% right now. Now we've got Tesla, Rocket Lab. That thing is just insane. The position is extremely small. But yeah, we're up 602.4%. You're going to ask me, oh, why aren't you selling this right now if you're up 602? Well, because I still think that the upside is quite immense in the future. And like I said, this was a tiny position that just became so big because it's up 602%. If we drop by 50%, fine, I'll add even more. I still think this can become a $100 billion company in the future. Then we've got Uber, Intel. Intel is going to be, well, on Thursday night earnings. I'm still down 19.4%. So yeah, I don't know how much lower this thing can go because the expectations for Intel are quite low. going into this earnings report. I fully expect them to beat their own guidance. But then, of course, all the questions are probably going to be on maybe some rumors, maybe who's the new CEO. Well, not maybe who's the new CEO. I mean, we're still waiting. We don't know. But yeah, it's going to be quite interesting. Alibaba, finally in the green, 3.25%. I'm still very, very positive on my, and a positive view on my Chinese holdings here. In my last AMD video, I did talk about DeepSeek and the CCP and how China is lying, etc., etc. And someone in the comments said, oh, if you're going to be anti-China and a racist, I will unsubscribe. How does that make any sense? Quite a strange thing to say to someone that owns Alibaba and Pinduoduo. Maybe that makes me a panda. Panda. Anyways, D-Local up 18.5%. This is one of those companies where I think 2025 is definitely going to be their year. Either an acquisition or finally the market will notice that this thing should be worth more. We've got Meta, we've got Micron. Micron, I'm already up 13.5%. I still want to build up my position a bit more. Pinduoduo up 8.75%. Then we've got Transmedics and Celsius still in the portfolio. I made up my mind. I'm going to wait until after the earnings season and see what happens. Those are basically, with Intel, my two losers of the portfolio. Thankfully, it's not a big position, so that's fine. 2% and 2.2%. That's fine. This is the newest position. This is Disney. I'm already up 5%. You're like, oh, you bought Disney, a WoW company. I explained everything in a specific video. It's still small, but I do intend to make this position bigger than Celsius, Transmedics, and maybe even Pinduoduo. And then we've got the two bets, basically, Appcelera and Owlet. Very, very small, 0.5% and 1.6%. It's basically, it's either a 10x plus or a 0. So voila. And so that's about it. I'm going into this earnings season with a significant amount of cash. I'm very, very comfortable with that. I will look for opportunities to add to, some of the positions here that I do want to grow more and more. And then hopefully, fingers crossed, Palantir does report great earnings and the stock crashes 30%. That would be the best case scenario. But then again, a lot of angry people will be in my comment section. So anyways, that's all I've got for you right now. Like, subscribe, all of that, and I'll see you all in the next one. Bye-bye.